Inflation is a term frequently heard in economic discussions, yet its profound implications are often misunderstood by the general public. It's a pervasive economic force that quietly, almost imperceptibly, erodes the very foundation of financial stability. Understanding inflation is crucial, not just for economists or investors, but for every individual navigating their daily finances. The true impact of inflation is its subtle but persistent erosion of money's value over time. This isn't a sudden, cataclysmic event, but a gradual diminishment that many fail to recognize until its effects become undeniable. This continuous decline in buying power touches every aspect of our economic lives, often leaving us feeling like we're running in place just to maintain our previous standing. This erosion affects everything from the cost of our daily necessities to the long-term security of our savings and investments. It influences our ability to plan for the future, make informed financial decisions, and sustain our desired quality of life. Grasping the mechanics of inflation is the first step toward mitigating its adverse effects on our personal and collective prosperity. At its core, inflation is defined as a sustained increase in the general price level of goods and services within an economy. This is not about the price of a single item fluctuating, but rather a broad upward movement across a wide range of products and services. When this occurs, each unit of currency buys fewer goods and services than it could before. This increase in prices is typically driven by an expansion of the money supply within the economy. When there is more money circulating relative to the available goods and services, the value of each unit of currency naturally declines. This fundamental principle of supply and demand applies just as much to money itself as it does to any other commodity. Government policies and the actions of central banks significantly influence the money supply. Decisions related to interest rates, quantitative easing, fiscal spending, and taxation can either inject or withdraw liquidity from the economic system. These powerful entities thus hold considerable sway over inflationary pressures, either intentionally or as an unintended consequence of broader policies. Ultimately, a greater amount of money circulating for the same quantity of goods and services inevitably leads to higher prices. This imbalance means that people are willing to pay more for finite resources, driving up costs across the board. It is this fundamental relationship between money supply and available goods that forms the bedrock of inflationary dynamics. The most direct and noticeable consequence of inflation is the rising cost of everyday necessities. For the average household, this means that the money they earn simply doesn't stretch as far as it used to. The weekly grocery bill, for example, becomes a constant reminder of this diminishing purchasing power, forcing families to reassess their spending habits. Items like groceries, gasoline, and utility bills are often the first to reflect inflationary pressures, becoming increasingly expensive. These are non-discretionary expenses, meaning consumers cannot easily cut them out of their budgets. This makes the impact of rising prices immediate and profoundly felt by almost everyone. As these essential costs escalate, consumers are forced to make difficult financial choices. Families may have to cut back on discretionary spending, postpone major purchases, or even struggle to afford basic needs. This pressure can lead to increased stress and a reduction in overall financial well-being for many households. This situation directly diminishes purchasing power, impacting the standard of living for individuals and families. What was once affordable or comfortably within budget suddenly becomes a stretch or entirely out of reach. Over time, sustained inflation can significantly erode the quality of life, making it harder to maintain a comfortable existence. Inflation represents a persistent, long-term trend rather than mere short-term price fluctuations. While daily headlines might focus on quarterly increases, the true danger lies in its cumulative effect over years and decades. This relentless upward creep in prices slowly but surely undermines financial security. It steadily reduces the real value of accumulated savings over time. A fixed sum of money, perhaps carefully put away for retirement or a child's education, will purchase significantly less in the future than it does today. This isn't a theoretical concern, it's a tangible loss of future buying power. Money held in traditional savings accounts or under a mattress will purchase less in the future, even if kept securely. The nominal amount remains the same, but its effective value is silently eaten away by inflation. This hidden tax on savings punishes those who choose to hold on to cash without considering its real return. This long-term erosion highlights the critical need for strategic financial planning. Failing to account for inflation means underestimating the true cost of future goals and potentially leaving oneself financially vulnerable. Protecting savings against this pervasive force requires active management and a keen awareness of economic realities. Businesses, much like individuals, face increased operational costs during inflationary periods. The price of raw materials, energy, transportation, and labor all tend to rise, making it more expensive to produce goods and services. This directly impacts their ability to maintain profitability and competitiveness. Rising input costs can significantly reduce profit margins for companies across various sectors. Even well-managed businesses can see their financial performance suffer as the cost of doing business outpaces their ability to pass those costs on. This pressure can lead to difficult decisions regarding production and investment. To offset these increasing costs, businesses may be compelled to raise their own prices for consumers. This is a common response to protect margins and ensure continued viability. However, this action also contributes to the overall inflationary cycle, creating a feedback loop within the economy. Such price increases can potentially lead to decreased consumer demand, especially for non-essential goods and services. As consumers face tighter budgets, they prioritize necessities, causing discretionary spending to fall. This reduction in demand, coupled with higher production costs, can contribute to a broader economic slowdown or even stagflation, where inflation coexists with sluggish growth. Inflation disproportionately affects individuals and households with lower and fixed incomes. These groups often have minimal savings, limited access to credit, and rely heavily on fixed wages or social benefits. Their financial elasticity to absorb sudden price increases is severely constrained, making them acutely vulnerable. Unlike higher income earners who might have investment portfolios or opportunities for significant wage negotiation, those on fixed incomes cannot easily increase their earnings to match rising prices. Retirees, for example, relying on pensions or Social Security, find their purchasing power steadily diminishing with each inflationary surge. This means their fixed income buys less food, less medicine, and less of everything over time. The struggle to afford basic necessities can exacerbate existing social inequalities within a society. As essential goods become more expensive, the gap between those who can afford them and those who cannot widens. This creates greater economic hardship for the most vulnerable, potentially leading to social unrest and increased demands for government intervention. This highlights inflation as not just an economic phenomenon, but a significant social justice issue. Its effects are not evenly distributed, placing an immense burden on those least equipped to bear it. Recognizing this differential impact is critical for crafting effective economic policies that aim for broad societal well-being and stability. In an inflationary environment, certain investments can potentially outpace the rising cost of living, preserving, or even growing real wealth. Assets like stocks, real estate, commodities, and inflation-protected securities are often considered hedges against inflation. They are seen as holding their value better than cash during periods of currency depreciation. However, outperforming inflation through investments is by no means guaranteed. Market conditions, economic downturns, and unforeseen events can all impact investment performance. What performs well in one inflationary cycle may not in another, making careful analysis and diversification essential. Furthermore, these investment avenues carry their own inherent risks and complexities. Stocks can be volatile, real estate requires significant capital and carries illiquidity risks, and commodities are subject to global supply and demand shocks. Understanding these risks is crucial for any investor considering these options as inflation hedges. Effective navigation of an inflationary environment demands careful planning, diligent research, and a strong foundation in financial literacy. It requires a clear understanding of personal risk tolerance, long-term financial goals, and the potential impact of economic trends on various asset classes. Informed decision-making is the key to protecting and growing wealth in the face of rising prices. One of the most deceptive aspects of inflation is the illusion created by nominal wage increases. When salaries rise, it often feels like an improvement in financial standing. However, this feeling can be misleading if the broader economic context is not considered. If prices for goods and services rise faster than salaries, an individual's real purchasing power actually decreases, despite a higher paycheck. What appears to be a gain in income is effectively negated or even reversed by the increased cost of living. This scenario means people are working harder or earning more nominal dollars, but can afford less. Understanding this crucial distinction between nominal and real purchasing power is vital for assessing true economic well-being. Nominal wages represent the dollar amount earned, while real wages reflect the actual quantity of goods and services those dollars can buy. Ignoring this difference can lead to a false sense of security and poor financial planning. Workers and policymakers must therefore look beyond the simple numbers on a pay stub or in economic reports. A comprehensive understanding of the economy requires evaluating wage growth in relation to inflation rates. Only then can we accurately gauge whether living standards are genuinely improving or merely treading water against the current of rising prices. Inflation is a complex, multifaceted global phenomenon, influenced by an intricate web of factors that extend far beyond domestic economic policies. Supply chain disruptions, such as those seen in recent years, can restrict the availability of goods, driving up prices worldwide. Geopolitical events like conflicts or trade disputes can also disrupt markets and create inflationary pressures on essential commodities like oil and food. Demand-side factors, including strong consumer spending fueled by low interest rates or government stimulus, can also contribute significantly. Expectations about future inflation can themselves become self-fulfilling prophecies, as businesses raise prices in anticipation of higher costs. This interplay of global and domestic forces makes inflation a dynamic and challenging issue to manage. Its long-term implications extend significantly beyond individual finances, touching every pillar of society. Persistent inflation can undermine economic stability, making it difficult for businesses to plan and invest, and for governments to manage national budgets. It introduces uncertainty and discourages long-term economic commitments. Moreover, high inflation can fray social cohesion, leading to discontent and political instability, particularly if its burdens are perceived to be unevenly distributed. When segments of the population feel their living standards are eroding through no fault of their own, it can breed resentment and distrust in institutions. Thus, understanding and managing inflation is not merely an economic exercise, but a critical endeavor for maintaining a stable and equitable society.